Hello everyone, let's start with our first reading of alternative investments. So, under alternative investments, we would be learning about different types of investments that are different from the traditional investments, the traditional kind of investments we do, like investing into any stock, investing into indices, and things like that. So, what is the meaning of alternative investments? Alternative investments falls under those investments that are not traditional investments. What is the meaning of traditional investments? Traditional investments are like investing into long only investments, that you are buying only these investments. You are not shorting any investment, short selling any investments in cash or publicly traded stocks or bonds. So there can be companies who are not out yet in the market, but you want to trade them. That is, they are not publicly, their stocks are not available publicly. But if you want to trade into these companies, those will fall under the heading of alternative investments and not traditional investments. The examples of alternative investments are hedge funds, private equity funds, private debt funds, real estate investments, investing into commodities, and so on. Why do we want, like, what are the benefits do we get from investing into alternative investments? First is there is a benefit of diversification. Like, let's say the traditional market is not doing well, but you can benefit from this diversification, that if the traditional market is not doing well, you have some money invested in alternative investments as well. So there can be a diversification benefit. Then low correlation. If my there's a low correlation between the traditional investments and alternative investments. That is, if the traditional investments market are falling, it would not lead to alternative investment markets also falling, again leading to diversification. Higher returns, because alternative investments are supposed to be, more riskier than traditional investments, because not much is known about alternative investments. After that, you are trading into illiquid securities. That is, securities you would not be able to sell that quickly, because if I am trading in a stock which is publicly traded, if I have that stock, I can directly go and sell that stock, and okay, someone would be out there ready to buy that stock. But if I'm trading into something which not many people are aware of, so me selling that stock, the selling capacity of that stock decreases. So I have in liquid assets with me. And after that, the alternative investment market is not that efficient, because not many people know what is happening in the market. So there is basically they are less efficient, and if you have any information, it can be that not many people are not aware of that information, and you can make use of that information and generate positive returns. So these are the benefits. What are the features of alternative investments? The first feature is more specialized knowledge of managers. So if you are someone who have hired a person for traditional investments, but you have not hired a person for traditional investments, you are well aware of the market, but in case of alternative investments, you may require some specialized knowledge of fund managers who are like specialized into hedge funds, or they may be specialized into private equity, or they may be specialized into real estate investments, and so on. So specialized knowledge of managers, fund managers are needed. Relatively low correlation with traditional investments, this we have discussed. Less liquidity of assets held, again because you would not be able to sell these assets that quickly. Longer time horizon for investors as compared to the traditional investments. Larger size of investment commitments. So you have to invest more money and you have to invest more money for longer time horizons. So these are the benefits, these are the futures. And what does these benefits lead to? Like because of these features, what happens in case of alternative investments? The investment structures facilitate the help of fund managers. Like because of the specialized knowledge needed in alternative investments, the investment structure would be such that you would directly be needing the help of fund managers. That is, you would be needing direct investment by fund managers. Information asymmetry. So whatever your fund managers may know, you may not be aware of that. There would be an information asymmetry between you and your fund managers. Difficulty in appraising performance. Like there would be no benchmark for you to compare your performance or to compare the performance of your fund manager with someone. Like whom should I be comparing, because everything is so specialized under alternative investments. Now, the correlation between traditional investments and alternative investments, they may be low in general, but in case of, let's say, there is an economic disturbance, so in that case, the correlation between the alternative investments and traditional investments can be high also. That is, if the traditional investments returns are following, the alternative investments returns can also fall. Now, what are the different types of alternative investments? So we have three broad categories under which we have divided our alternative investments. The first category is private capital. Second is real assets. Third is hedge funds. Under private capital, we have private equity and private debt. So under private capital, what happens? You are giving money to companies that are not publicly traded. Their stocks are not publicly trading. These are private companies. They haven't gone public yet. So you can give money to a company as an equity that you can be in. You can be a shareholder of the company. What you can do? You can be a venture capitalist. That is, you can. What is venture capitalist? That is you are investing into an entrepreneurship. You are investing into uh, you are investing into something which is new yet, but you believe in the capability of that company. The second can be leveraged buyout, LBO. A company is private, but you want to take over that company because you believe in the potential of the company. So you can be investing into the equity of the company for the motive that you want to buy that company, or you can be lending money to the company as a debt if the company is not doing good. Let's say the company is not doing good and is in a distressed position. You can lend. money to the company. This is called distressed debt. Or you can also lend venture debt, again investing into young companies. Second is real assets, real estate, natural resources, commodities, farmland, timberland, infrastructure, digital assets. Then comes to real assets, that is, you can invest into assets which are real. You can invest into real estates, you can invest into buildings. Like you believe that, okay, this building, this whole setup infrastructure is building is built into a good locality, and maybe doing good into the future, like after 10 to 15 years it will be doing good. So what kind of investment that would be? It would be a long term investment, because for a building to be built it would take around 10 to 15 years. After that, people would come buy flats, or buy flats on rent and everything. So for your return, the return that would be generated, it would take around 10 to 15 years. So the investment horizon is bigger, the money would be required to invest into something like that would be bigger. So you can invest into real estate, or you can invest into natural resources, like you can invest into commodities. Like you can invest into crops, you can invest into silver, you can invest into gold. You can directly buy these commodities, or you can invest into the indices of these commodities. You can buy a farmland, that is, you believe that this crop would be needed in the future, so you can buy a farmland and make use of it. Or you can buy a timberland, that is basically, you believe that the demand of woods would be increasing in the future, so you can make profit from selling woods. After that comes investing into infrastructures, that is investing into highways, investing into building public parks and so on. We call this public private partnership. Then comes investing into digital assets like cryptocurrencies. Then we have hedge funds. Hedge funds are investment companies typically open only to qualified investors. Because of whatever the complexities are involved in the investment of the hedge funds, the managers use leverage, the managers short sell the assets. So there are many complexities involved which may not be understood clearly by normal investors. So hedge funds are only open to qualified investors who understand the financial terms and who understand what kind of risk are they taking. Because the fund managers may use leverage, hold long short positions, use derivatives, and invest in illiquid assets. We have three different types of investments. So these real assets, hedge funds, and the private equity and private debt. Under L1 in alternative investments, you would be learning about these different types in detail. Like would have specific chapters related to these. Coming to three different types of investments. First is direct investment, co-investment, fund investment. Let's keep fund investment. here and direct investment there. So when you are, let's say you are starting into the whole horizon of alternative investments, you are new, you do not know much about alternative investments. So the first, the strategy which you can opt for is fund investments, wherein you are investing into a pool of assets alongside other investors. So there would be a fund manager. The fund manager would be managing this whole pool of assets. The fund manager would be deciding what asset basically the manager wants in that pool. You just have to decide. There would be a term sheet, funds term sheet. So you just have to agree to this term sheet that okay, I'm comfortable with you taking only this amount of risk, and these are the strategies I'm comfortable to you. So these type of things would be mentioned in the term sheet. But apart from that, what assets do the fund managers feel are good for the pool? What kind of money the fund managers want to put into each asset? All that those decisions would be taken by the fund manager, and you would be investing into that pool of assets alongside various different investors who also have entered into that same agreement with the fund manager. So individual investor, you as an investor do not control the selection of assets. You do not control what kind of assets you want to hold, uh, or you want to sell this asset right now, or you want to hold this asset and sell this asset after one year into the future. So these kind of decisions are not under your control. It is under the control of fund manager, and the fund manager would be receiving two types of fees. First would be management fees and incentive fee or the performance fee. After that, co-investment is like a mid between fund investment and direct investment. You, after learning something, let's say you have you have seen your fund manager closely for 2 years, 3 years, you have observed your fund manager. Now you have developed certain skills, but you're not very sure of your skills till now. So you can opt for co-investment, wherein you, along with your fund manager, like you are also involved in a pool of assets wherein your fund manager is taking care of whatever assets they want to buy, they want to sell, what kind of money they want to put in. But along with that, you are also simultaneously investing into alternative investments on your own. Now, direct investment, as the name suggests, is rather than the pool of assets itself. You are not involved in any pool of assets. You are not paying any fee to the fund manager. You are taking care of your investments yourself. You are taking the decision what kind of assets you want to buy, what kind of assets you want to sell, what kind of money you want to put in your investments. What is the structure of alternative investments? Like, what are the different compensation structures? So, alternative investments, they are generally structured like limited partnerships. What are limited partnerships? Under limited partnership, there would be certain partners who are general partners, and then there are limited partners. Limited partners, they are not involved in the day-to-day regular, day-to-day decision operations of the business. They are not involved into uh, what kind of ventures they should invest. So their liability is also limited to the amount they have promised to the firm in the under the partnership agreement. But general partners, they are involved in the day-to-day business or day-to-day operations of the business. They are the ones who decide for the business. So alternative investments are also structured in a way of limited partnership, where who are the general partners who decide for the alternative investments? The fund manager decides. So the fund managers are the general partners. They decide what kind of operations they should undertake in the alternative investments. And the limited partners are what? The limited partners are the investors who usually they do not have any risk beyond the capital they have invested into the alternative investments. Their risk is limited to the capital they have investments. Beyond that capital, they do not have liability. So only till the amount they have promised, that is their liability. If the whole pool of funds for make losses up to their liability amount, up to the amount which they have promised would be their liability. Beyond that, they do not have any accountability. Limited partners do not have any accountability. So, at the initiation of the contract, limited partners would be committing certain fund that, okay, I'm ready to give you 10 lakhs as my part. I'm ready to give you 10 lakhs. Now it's upon them, it's upon general partners when do they need the money, because the also the whatever the fees would be, the management fees, that would also be decided upon the overall fund which the limited partners have promised. Why it is the case that the fees is decided upon the overall fund which they have committed and not the fund which is currently invested? Because if that would have been the case, then the general partners would have asked the limited partners that, okay, uh, even though the opportunities are not good out there in the market, but because the fees is dependent upon what kind of investment, the fees is dependent upon the money they have, limited partners have invested at that time. So the general partners, what they would do that, okay, you give me the 10 lakh rupees right now, they would just invest it into somewhere so that their management fees could increase. So in order to avoid this disadvantage, the fees, the management fees is dependent upon the whole money which the fund, which the investors have promised. So the limited partners, they would be deciding upon some fund level. In our case, let's say it's 10 lakhs. So they have decided that, okay, I would be paying you 10 lakh rupees. Now it's upon general partners when they do need this 10 lakh rupees. They may need this 10 lakh rupees in chunks, that, okay, you give me 2 lakhs right now. After 6 months, they may come and feel like, okay, the investment opportunities are good. You give me 3 lakhs right now. So it depends upon the general partners when do they need the money. So this kind of arrangement is available only to accredited investors or qualified investors because of whatever risk is involved. The rules and the operational details that govern the partnership are contained in the limited partnership agreement. So there would be an agreement which they would have to, agree upon. So whatever rules and the regulations, the decisions would be, that would be agreed upon in this agreement. Special terms that apply to one limited partner but not others can be given in side letters. Like there would be a partner, let's say, who would have invested more money into the fund. The partner would want advantage that you at least tell me a month or 2 months before that you would be requiring money from me or anything like that. Okay, I do not need I need more percentage of returns which you're generating from me. Like if you're generating certain amount of return from me, I would want 10% of that return in that month itself. I do not want my returns to be postponed to some later payment date. Any kind of special agreement between the limited partners and the general partners, which is limited to only one partner and not everyone would can be given in the side letters. So limited partnership agreement would be an overall agreement between the general partners and limited partners. If any specific agreement is made for only one limited partner, that can be given in side letters. Then come excusal right. What is excusal right? That is, a limited partner may have negotiated between with the general partner that I hold the right to decline you the money. Like, you cannot come at any point and tell me that you need money. I hold this right that I can decline you the money at that point. So this is what this is called excusal right. So this maybe one limited partner has been given this excusal right. So this excusal right can be presented in the side letters. Then comes most favored nation clause. Now, if one partner has been given something and the other limited partners also want this to be favored to them, so this can be presented in the most favored nation clause. Now, most limited partnerships, they are private and they are not publicly limited. There is master limited partnership (MLP), which can be publicly limited, which also reduces the risk. Coming to the last topic, fee structures. How are the fees decided? As we have discussed that broadly there would be two fees which the fund managers would be charging. One would be the management fees, the other would be the performance fees. The first is the management fees. It is typically 1 to 2% of the whole funds they are managing. The other can be the performance fee, incentive fee. So management fees would be something the fund managers would receive regardless of how the fund has performed. In the case of hedge funds, management fees are calculated as a percentage of assets under management. In the case of hedge funds, management fees, like it's two, if it's 2% management fees, it would be 2% of the assets under management, typically net asset of the fund's value. For private equity funds, management fees is calculated as a percentage of committed capital. This is what I was discussing, that management fees is calculated as a percentage of what the committed capital is. That is at the percentage of rupees 10 lakh and not the drawn capital. That is the fund manager has only drawn rupees 2 lakh till now and not and 8 lakh is remaining, but the committed capital was rupees 10 lakh. So the management fees would be calculated on rupees 10 lakh and not rupees 2 lakh. So there's a committed capital, the capital which is committed totally 10 lakh. Then there's another term which is drawn capital. So this is the capital which has been drawn by the fund manager. Then comes dry powder. Dry powder is the remaining 10 lakhs. That is the capital which has not been drawn yet by the fund manager. Now, performance fees would be paid only when certain requirements. That is, I have decided that you would be generating me at least 10% of returns. So, if the fund manager was able to fulfill this requirement, then only the performance fees would be paid. So, generally, hurdle rates are decided. Hurdle rates can be soft hurdle rates or hard hurdle rates. If a soft hurdle rates are met, performance fees is what? Performance fees is percentage of total increase in the value of each partner's investment, and if it's a hard hurdle rate, performance fees is based on only the gains above the hurdle rate. Let's take a numerical example. Let's say if it's a soft hurdle rate and the rate was decided as 8% and the returns generated were 12%. So if this soft hurdle rate, this 8% rate was met, this hurdle or whatever level you have decided it is met, now the performance fees would be what? Performance fees would be 12% of the whole returns which have been generated. Now, if it's a hard hurdle rate of 8%, then performance fees would be what? That okay, you have met the hard hurdle rate of 8%. What is the differential? You have generated 4% more. So performance fee would be 4% of whatever the payment structure is. So performance fees are typically paid after what? After they are paid annually. After all the whatever the expenses are, they have been they have been deducted from the fund's overall performance. After that, the performance fees is calculated. That okay, these are the expenses I was liable to pay. Then comes catch up clause. Catch up clause is similar to in its effect to the soft hurdle rate. So let's say a fund has generated 14% returns. 14% returns the fund has generated. The hurdle rate is of 8% and performance fee is 20%. So what would have happened, like coming to the hurdle rates, what would have happened if the performance fee is 20% and 8% is the hurdle rate? In the soft hurdle rate, what would be doing? 14% of 20%, because you have met the hurdle rate, so you'll be getting 14% of the whole gains which have been promised. And in the case of hard hurdle rate, you are getting just a differential. So 14% minus 8%, that is 6% of the 20% performance fees which have been promised to you. So that was the case of hurdle rates. In case of catch-up clause, what would happen? You have 14% returns. So the first 8% returns, you have been promised that this is my hurdle rate. So this I would be for sure paying you. So this is the hurdle rate. So first 8% return will solely be going to the general part, to the limited partners or the investors, because this is what the rate I have promised them. After that, the general partners or the fund managers would be given an opportunity to catch up to the lost profits. So the next 2% would only be reserved for general partners. Why? Because if the performance fee is 20%, if the performance fee is 20% and the returns are 10%, then 20% of 10% would be what? 2%. So 2% of the returns I should have gotten if the fund has generated 10%. So for the first 8%, I demanded no share from you. But now you have got your first 8%. But I should have also gotten 2% if the fund has generated 10% returns. So the next 2% returns would only be given to general partners. After that, we are left with 4% returns. This 4% returns would be shared between fund managers and the limited partners, investors and the fund managers. So 20% is the performance fee. After 4%, like this 4%, 80% would be given to the limited partners and 20% would be given to the general partners. So the first 8% return, when the hurdle is not yet met, I would not say anything. The whole profits would go to the limited partners. After the hurdle rate is met, the general partner would be given a chance to catch up to the remaining, to the basically to the lost profits. So after the general partner is done catching up to the lost profits, the remaining profits, that is the rest 4%, would be shared 80 and 20, because 20% is a performance fee. So 20% the limited partner, the general partner would be taking, and 80% the limited partner would be taking. Another feature which is included is high watermark, which means no performance fee is paid on gains that only offset prior losses. This helps whom? This helps the investors. That is, let's say, in a span of 3 years, okay? Let's say 5 years. It was 2, 3, 5. So in the first year, you have generated me a return of 10%. Okay, in the next year, you have generated me a return of 15%. Now, in the next year, so this is my high watermark. I have generated a return of 15%. This is the high watermark for the fund. In the next year, the return falls to 8%. Okay, so return falls to 7%. Here, the hurdle rate is not met, nothing is met. The performance fee would not be given. In the next year, in the fourth year, the returns generated were 11%. So the performance fee, the hurdle rate is met. 8% was the hurdle rate. Also, they have generated a positive return. From 7%, they have gone to 11%. But if the high watermark clause is there, the highest watermark, that you have generated 15% return to me in the second year. Now, the rise from this to this is nothing but an offset to the whatever prior loss. The loss you have made here from 15% to 7%, the returns had fallen. So the rise from 7% to 11% is nothing but an offset to the prior losses which you have done. So this is my benchmark. I would only be paying you if in the fifth year the return goes to 17%. So now you have generated more returns to the highest watermark, which was 15%. In this case, I would be paying you the performance fee, but not here, because this is just an offset. This gain is just an offset to the prior losses. Coming to the last second arrangement, which is waterfall. We have two types of waterfall arrangement. We have European waterfall and we have American waterfall. What is American waterfall? American waterfall is deal by deal. European is whole of fund. So under American waterfall, what happens? Deal by deal is considered. So you will consider one deal, okay? If in one deal the hurdle rate was decided as 5%, if this is met, all my previous whatever investment I had done, I had invested rupees 10 lakh in that, 5% hurdle rate is met. Over and above, if return is generated, the performance fee will be given to you. Deal by deal, deal 1, deal 2. So what happens in deal 1? The performance fee was met, the hurdle rate was met, and profits were generated, well and good. But in deal 2, even the hurdle rate was not met. But the hurdle rate was not met, and whatever investment you had given, you have not even gotten the full amount of the investment yet. So in deal 2, you had negative returns, but under American deal by deal, fund manager would be getting performance fee for deal 1. It won't matter that for deal 2 the fund manager has generated negative returns. So American waterfall or deal by deal waterfall is advantageous for whom? It is advantageous for fund manager or the general partner. Under European waterfall, the combination of these two deals would be considered, deal 1 and deal 2. And when you have gotten the whole investment you have made, like I have invested 10 lakhs in this, 10 lakhs in this, and 5% was my hurdle rate for the overall investments. So if I have gotten rupees 20 lakh in whole along with my hurdle rate on of 5% on this 20 lakhs, if these two, like overall the whole of the funds requirement has been met, after that the fund manager's performance fee would be generated. So European waterfall is benefitable for limited partners or investors. Coming to the last condition, clawback provision. Clawback provision is that the general partners have taken some profits from you, some incentives for you for the deals they have undertaken till now. But after they have exited the deal, or after certain conditions, after some time, the scenario has been reversed, and whatever the profits they have generated to you, the profits no longer lies. So whatever performance fee you have given to general partners, the general partners would be liable to pay back that performance fee to the limited partners. So under deal by deal waterfall, that is under American waterfall, if under deal by deal waterfall, if American waterfall is accompanied by clawback provision, what would happen? That okay, the fund manager has exited a deal. When the fund manager would have exited the deal, after that only deal 2 would be left, leading to negative returns. The hurdle rate would not have been met. So if clawback provision is there, then it would help the limited partners to get the profits from the general partners for whatever deal they have exited, because after they have exited a deal, it would have, it has generated negative returns for the limited partners. So that is it for this lecture.